but I'm also delighted to be here and continue this discussion led by Shane, one of our most experienced and renowned executive search professionals here in the region, who can really help us guide through some of the key topics from the, let's say, from the executive search side. But what I always like about him is actually it helps us to project what it's actually like when you're sitting on the other side of the table. If you're, for those who have ambition to be CEOs, to gain even more senior leadership, the kind of tips that Shane will explore will help you, frankly, on either side of the table, either as a hiring manager or as a potential candidate. So that's why I'm so excited about topics like this.
Great, thanks, Pete. Yeah, I guess if people are just wondering, why I'm doing this. My dad started our company, the Phillips Group, in 1984 in Canada. I think since then we've interviewed over 240,000 candidates and helped boards and CEOs select their leadership teams all over the world. And one of the things I realized is a lot of times people who are in charge of choosing their CEOs generally may not have any formal interview or assessment training. And so we decided to start to do a series on that. And we wrote a book on it as well called CEO Assessment Selection. And so that's basically why I'm doing that, and helping also to share my excitement for this area. And I think it's one of the most important skills you'll have in your life. And I was just talking to one of the biggest group CEOs in the region, and he was in total agreement with me that one of the most important skill you can have as a group CEO is the selection of your divisional CEOs. And he went on to say, it's not just the decision of my CEOs, it's also my chief marketing officer, my head of HR, so choosing your people is really going to make or break you in a business. Today we're going to be looking at, if I can just share my screen, the M&A skill set. And I know if anybody's in HR, I think we have a mixed bag of people here. Some of them are high street finance. We have some, I think, proper investment bankers with us today. And is my screen, nope, I think I have the, nope, sorry, a little glitch here with the sharing. There we go. Okay, is it sharing now?
No, not yet. Now it is. Okay, great.
Yep, we can see it now, Shane. So if you just go into presentation mode and you can put it on the full screen.
Yep. Trying. I don't know if is that working? There we go. Okay. So can your candidate lead your CEO growth? Here's a quote. I don't know if anyone knows who the quote is from. This quote is from T-Bone Pickens. And I just was highlighting another dialogue I was having with one of my group CEOs that's saying that what?
It's not coming up on your screen, Shane.
It's not showing. I was wondering because that was like a bit of a racy quote that I was showing on the screen, and I wasn't getting any reaction. So I was like, okay, sorry for the glitch here. But okay, is it showing now?
Yes.
Okay, so this obviously is it going to go full screen? Is it full screen now? No. It's not? I think I got to kill the, okay, 1 second. I have this fixed here, folks. I will have this, just give me one exact second. And voila, now it should be, right?
Yeah.
Now it is? It's
yes,
full
it
screen
is.
now? Okay, there you go. So I'm impressed with myself. I was able to fix a technical glitch. Okay, so this is basically a quote from T-Boone Pickens. Does anyone know who T-Boone Pickens is?
He's like an oil man, wasn't he?
Yeah. So he basically, and I mean, the reason why I picked this quote is because a lot of my CEOs are saying, look, they can be at a disadvantage because they're competing in the market as a professional manager against owners. And owners, the way they run their business, the way they're going to approach value creation is going to be different than the way a manager will. And so this was T. Boone Pickens was the grandfather of the hostile takeover. And so what's that? What's going on?
I think it's still going, Shane. It's okay.
Okay. 1 second. Bye. Screen sharing stopped. What? Okay, this is the last time. Sorry about this, guys, ladies and gentlemen. Is it showing now?
Yes.
There we go.
Yes, it is, Shane. Yep.
That's the last time we have to deal with that. So basically, T. Boone Pickens was the grandfather of the hostile takeover, and he basically would take over companies much larger than himself. And so, and he felt that he was able to do this because those CEOs were really not owners. He didn't feel they really knew the business as well as he did. And he ended up making literally billions of dollars. If you don't know T. Boone Pickens, he's one of the original oil wildcatters from the US. And literally deal after deal after deal, he was kind of really the person who paved the way for the strategy and approach to creating the hostile takeover. I'll just touch on a couple quick case studies. I mean, everybody's familiar with Saatchi and Saatchi. From 1972 to 1987, they did 35 takeovers. I don't know if anybody knows who the finance director of Saatchi and Saatchi during that period was. A very famous person. He has a sir. He was knighted. Nobody knows. The famous. So Sir Martin Sorrell. Sir Martin Sorrell really optimizes the power of the M&A strategy because he bought a plastics company, and within a few years becomes the largest advertising firm in the world to surpass Saatchi and Saatchi. And from a talent perspective, it's also very interesting to see the who's really the creator of value in this. Is that, you know, advertising is known as that kind of artistic, quirky talent that's coming up with all these things. That's what's creating the value. Of course, Sir Martin Sorrell proves that it's really finance that is the real value creator in this particular business case and model. So what we really want to look at is, you know, what are first of all, does your CEO understand the strength and the power that the acquisition strategy actually has? Oh, is my video not on as well? And
yeah, you're not on your video, Shane.
There we go. Sorry, I had to switch. Is that better? Okay. Sorry, guys. No, it's going on.
No, you need to lower down your screen a bit. Okay.
I'm having all kinds of glitches here, but keep marching on no matter what. So does your CEO really understand what the strength of this lever is? Do they understand how to use it? And do they have the capability? I'm just going to give a quick shameless plug here, but our book, CEO Assessment and Selection, is actually ranked #1 on Google for CEO Assessment and Selection. And just so you can see that the only other person who's competing with us in the top 5 spots is Harvard Business Review. And so just to give you an idea where this content is coming from. So that's enough of the shameless plug. Back to the M&A assessment. So when we're assessing it, you really want to understand what's the value chain of your M&A strategy. So the first thing we're really going to look at is, can your CEO come up? Do they have the right skill sets and capabilities to drive your M&A strategy? Secondly, how are they targeting the acquisition companies? How do they do their due diligence? What's their acquisition planning like? And then these last ones, you know, on the evaluation, how involved are they on the evaluation? Do they really understand the evaluation piece of it, or are they accepting a value? So if I tell you, for example, if I bring the top accountants or assessors in the city, and I bring a bottle of water, they actually will not be able to tell you what the value of a bottle of water is, because I can buy, you know, a premium water in the store for, you know, $10. I can get a regular bottle for $1. I can go to Pete's office or Nasser's office. I can have a bottle of water for free. Or is it the cost of the, you know, the actual intrinsic value of the water plus the value of the packaging plus the value? So you're never really going to get this actual, this actual value. And then value creation. And the reason why we separate it is to really understand that a lot of organizations will basically silo these functions. And so if I'm dealing with a CEO of a multinational company, you might say, okay, this person is from this Fortune 100 company, brand X, this CEO has to be awesome. But in reality, that person is being supported by a corporate M&A team. That person will be dictated from the head office that, hey, by the way, we're going to be buying this textile plant that we've done the due diligence on. I want you, you know, to go over the school across the street and start the process. So they're really executing that deal. The other thing to also remember is if it's a local company, two chair people, you know, might be doing a deal between each other. That chairperson is then going to call their CEO, you know, I want you to go over to Mr. X's house, and you know, this is the deal. We're buying the retail chain for this price, and they're executing it. Another one is, you know, board members, ultra high net worth individuals, they get excited. They've always wanted to own a hotel in Zurich. You know, they get a deal, you know, one of the E&Y or whoever brings them the deal, private bank brings them the deal. The guy says, I want it. Next thing you know, the CEO is on the plane to go and execute this deal for his chairman or for her chairman. So we want to understand how the deals are actually created. And then there's a very limited number where the CEO himself has or herself has a vision. We want to be the largest chocolate business in the world. You know, we're going to go around and start acquiring, you know, the top 3 chocolate businesses in every country. And these are my lists. And, you know, hey, I want to go have dinner with the chairperson of this particular company and then execute it. Now, which CEO is right for you is really dependent on what you want to do with your business. And remember that the way the CEO is approaching acquisition tells you a lot more about the CEO's skills in other areas. So what do I mean by that? I'll just walk you through this example here, and then I'll show you how, by looking at how somebody approaches their M&A strategy, it actually showcases if they have gaps or weaknesses in any other critical areas for this that the CEO might have. So this is a real case. This is a real case. Company has 20 hotels, and they're cash rich. Okay, they have been making money hand over fist, and they're cash rich, and they can buy whatever they want to buy. Well, within reason, you know. You know. So, for example, if there's an acquisition that has $100 million or $200 million US dollar ticket price, you know, they can easily participate. So, how does the CEO in each case, and how is the board talking and thinking about M&A? So the first one is, hey, our board is VIPs. We're going to have proprietary deal flow. We'll get first right of refusal on, you know, some really sexy deals. And so let's go with that. We're going to be opportunistic. This is option one. The second one says, no, actually, guys, you know, our strength is our ability to create unique buildings, unique structures that are iconic. So we should really focus in construction and architecture and really being a real estate developer, a master planner and real estate developer, where we anchor our projects with our hotel. The other one says, no, you know, really, we have 20 hotels. People come for the service, and we're a management company. And so we really need to focus there. And then the third one is like, guys, that has nothing to do with it. Where's the money? The revenue comes from booking online. We're an IT company. We're an application. And so we should just lose the brick and mortar, lose the management, and just be an app. And our ability is to say, hey, how many rooms do you have? 500 rooms. We can sell those rooms every day for you for the next 365 days. This is actually like a real dialogue that's going on with the board members. So who are you? So identity becomes a really big part of your puzzle. And so let's look at what happens here. So what happens in the opportunistic one is the acquisition is not linked to your vision or strategy at all. And you start to get, in this actual case, they bought a laundry company, they bought a catering business, because I don't know if you know, like the hotel staff, there's a lot of staff. They don't actually eat in the hotel restaurants. They actually usually have a third-party caterer that feeds all the staff. So they bought a catering business, they bought a laundry business, they bought a 5-star hotel, they bought a 1-star hotel. And so you end up with this kind of smorgasbord of assets, which you could say, okay, fine, they're all hospitality related, but are they really creating value? And so here you start to see companies that have now focused in one area, and what's the outcome of that? And as you go into, for example, looking at the Airbnb model, Airbnb systematically went after its direct competitors in every single country and acquired into Germany, acquired into UK, acquired, you know, they bought companies like 9 Flats, like Crash Patter, and systematically built up a portfolio. And it wasn't just the fact that they acquired these businesses. They were able to successfully merge them into their platform, make them successful, make it a one cohesive brand. And so when we look at this, we start to say, okay, well, the CEO who's really being opportunistic, maybe they lack a sense of identity, whereas the Airbnb people really know, hey, who are we? We're an online business. You know, we're an e-commerce business. We're not a hospitality business. So one of the top things that you want in your CEO and as in a great leader is that they give us a sense of identity. You know, when you meet someone from the UAE, if they're from Dubai, they're not going to tell you that I'm from the United Arab Emirates. They're going to say when they're overseas, they're in, you know, Miami or New York, they're going to say, yeah, I'm from Dubai. And you get a different response. The same with, you know, if you have American friends who are from New York City, they won't say they're from America. They'll say they're from New York. And it's a much different sense of identity. And that's what our leaders give us. Pete, you're smiling. I don't know if the Australians do the same thing, or I'm not as familiar with the...
No. I was more smiling about the Dubai reference. I think you're absolutely right. Makes a lot of sense.
Yeah, and that's what Sheikh Mohammed, the ruler of Dubai, he gives us a sense of identity. Even for those of us who aren't Emirati, you still go, hey, I live in Dubai. It has a bit of sizzle to it. So first of all, when I look at this, I start to think, hey, you know, your CEO candidate doesn't have a sense of identity. He or she won't have a sense of vision. He or she may not have ambition as well. Because when you are not investing in your acquisition strategy, it might also indicate that you don't have ambition for that business. You don't believe in that business. So you have, for example, a beverage business that you own locally, and overseas you start acquiring other businesses. Maybe you don't believe in the ability of your beverage business to be successful in Australia or to be successful in the UK, you know, versus someone who's running Red Bull. You know, the founder of Red Bull felt that every single person on the planet should be drinking Red Bull. And so they really invested in the growth of that brand. So, if that makes any sense. But so let's get started. Some very simple questions that you just want to grab out of the gates that will save you some time. So as I said, I always like to start with identity and just ask them, hey, are you an M&A guy? Are you someone who really can drive inorganic growth? Is that who you are? And CEOs, the more senior that somebody is, the more comfortable they're going to be at admitting where their gaps are and where their strengths are. So if you go and ask Michael Phelps, are you a good sprinter? He's going to be very comfortable telling you, like, no, I'm not a good sprinter. I'm a swimmer. And, you know, I'm one of the most decorated Olympic swimmers of all time. And that's what you kind of want to get into. It's going to save you a lot of time. And then you just quickly want to get into, you know, like, how many M&As have you done? And so when the person starts to say how many M&As they've done, this is where the challenge starts to become, because, you know, when you're doing an M&A, you're going to have an investment bank involved. You're going to have one of the big four involved. You're probably going to have another management consultancy like Alvarez and Marcel or someone like that involved. And then you're going to have the board involved. You're going to have your internal finance department. So the CEO will be surrounded by an army of extremely competent people.
And so if you're not good in M&A, you generally, it generally shouldn't be an issue. So the CEO may not actually do anything, even if they have been part of 5, 6, 7 M&As, which is something that we covered before. So once you get past this initial piece, what are the basic questions that you really want to ask to ascertain if this person actually got their hands dirty or not? And I don't know if we have anybody, we have some heavyweight finance people in the crowd, so I don't know if anybody would like to jump in here and say what they would ask or not. Anyone? You guys, Pete, I don't want to put you on the spot because this is like a rare skill that generally, you know, most companies, they don't actually need it. So it's not a mandatory skill, you know, to be a CEO. There's a lot of CEOs who will never really go down the M&A route. Which is fine. Okay, so we're not getting any. Okay, so then good thing we have this slide here, so you guys will get the questions now as I review them. For me, the one that really cracks the cookie for me is, you know, asking them, how do you decide your discount rate? And a lot of CEOs will be handed the discount rate either by the investment bank or their personal bank or their consultant. And the discount rate for those people, I mean, how many people we have that are not really necessarily finance people, when you're doing your corporate finance, you know, one of the core metrics or one of the core data points that you want is your weighted average cost of capital, which in just simple English tells you, you know, how much premium you want to get back on your money given the risk that you're being exposed to. So in simple dollars, you know, if I'm running a business in Syria right now, obviously it's a challenging environment, and I say, you know, hey guys, you know, this situation is going to be very calm coming up, and you know, I have a restaurant chain, it's just going to explode. You guys should invest. So you want to put, Nasser wants to put $100 with me. He's going to want a much larger return because that money could disappear. And Pete is like, hey, you know, I'm going to Vancouver next week, and we have, you know, this very stable plastic business you can invest in, and you know, he's going to get you know, the chance of anything happening because there's nothing around Canada except for the U.S., which may be a concern on other levels, but you know, it's pretty stable. So you don't want as much of a return. So this is the quick calculation of how this works. So you need to, in order to calculate your weighted average cost of capital, you need to understand what the cost of capital is, and that's where in the cost of capital your discount rate is actually actually used. It's also used to get your net present value, your average present value, adjusted present value. And basically, you want to say how much of a discount should I apply to my future cash flows to understand what the value of that cash flow is today. So just to go back, so when a person says, yeah, I've done 7 or 8 M&As, okay, which was your most complex or which was your favorite? The guy says, oh, you know, when we acquired Aston Martin. Okay, great. You acquired Aston Martin. You were leading that. How did you decide the discount rate for this? And then what was your weighted average cost of capital? How did you come up with it? Another easy question to ask is, you know, it all really comes down to, does the CEO understand what the cost of capital is? And so when you're working internally in a company, if Pete owns the business, Pete has, you know, X amount of cash, and I'm running his manufacturing plant. We're manufacturing, you know, these beautiful lion mugs, and I say, look, you know, people love these mugs, Pete. We could sell so many. We just need to expand the plant, and you know, I don't really feel like taking debt. So I need $5 million. So Pete says, no problem. You know, he's super loaded, and he passes me the $5 million. A lot of times, we're not calculating internally what the value of that is. So does the CEO really understand that there is a cost of capital involved in giving me that $5 million, even though it's being funded internally? And it becomes more complex if Pete has 3 CEOs like me. One's running the coffee mug plant. The other one's running a fintech business for him. The other one's doing a construction business, and they all want that $5 million. Now, what's the cost and what's the hurdle rate, and how does the CEO apply it across the different assets? And that's what we really want to understand. So that's basically the first piece, is understanding the cost of capital. Then the next thing I really want to understand, which really gives you an idea, is how is the CEO originating? So if the person is saying, look, I'm really going to be involved in the M&A, how are you originating your deals? That is really the core piece. So if they're waiting for the consultants to provide them cooked deals, as we call, quote unquote, cooked deals, that, hey, I'm working on the sell side, and I'm bringing you sell side mandates. Here are 5, 6 companies we have for sale. Would you be interested? Or is the candidate really creating their own strategy? I'll just give you another example. So Blockbuster, I don't know if you guys remember this. If you guys had Blockbuster in North America, we had Blockbuster, very huge video store. CEO comes in, CEO of Netflix at the time. They were hemorrhaging money. They were blowing. I think they were losing like $5 million a year or more, and I think the losses had accumulated significantly. They went to the CEO of Blockbuster and said, "Look, you guys want to buy Netflix? It's for sale." The Blockbuster CEO said, "How much?" $50 million. And the guy from Blockbuster said, "No, opportunistically, it doesn't make sense because you guys are losing so much money." And so look at the candidate who's more strategic. They say, "Hey, we really need to be in the e-commerce space. We really need to be involved in online entertainment." And then it would change the way that you really look at this acquisition.
Exactly. Having the vision is very critical for the business itself, and how to integrate it later on adds a lot of value to the whole M&A. That's one thing. So I love the example that you just gave right now, Shane. Makes a ton of sense. Kind of like what we've seen at Microsoft right now. They did multiple M&As to get where they're at today. So it makes a ton of sense from that angle as well.
Do you think, Shane, do you think with hindsight that a better Blockbuster CEO would have spotted the Netflix potential and made the acquisition? I mean, I think there's been a lot of data about this, a lot of interesting reading and around, could a reasonable person have really seen what a big idea was really going to be?
And that's exactly what I'm saying. And so when you go back to what are your core competencies for the CEO, and the number 1, vision, number 2, strategy, leadership, management, revenue generation, financial literacy, and results orientation. And so right away, when a company is put into a Red Sea ocean where it can no longer be profitable, that is the responsibility of the CEO and the board. The board and the CEO together hold responsibility for setting that vision and what are the capabilities that we need to compete 5 years and 10 years down the road. And it shouldn't have been, when you take, like the disruption that Amazon has caused, for example, it really shouldn't be a non-retail business. Jeff Bezos actually came from Wall Street, where he learned the algorithms that they were using in quant trading and applied it to the book market. But it really shouldn't have come from a non-retail business. It should have had a CEO in the retail business that had the vision to see where we're going and really evolve with it. And if you get your identity statement wrong, say, hey, we're a VHS company, or like Kodak, for example, where they really had the identity that we're a film business, despite the fact that they invented the technology that disrupts them. They don't have the vision. And so who's responsible? I mean, this is a great question, Pete. And this is always bounced around like a hot potato, where a lot of boards are saying, we want the CEO to come in and create the vision. And the CEO is saying, oh, well, we want the board to create the vision. If you're going to be a successful at that level, you really need, that's what we're paying you for. That's what we're paying the CEO for, to say, hey, this is what the future of this business looks like. And, Jeff Bezos himself always cracks me up when people ask me what my results are going to be next quarter. He said, that's not my job. He's like, I'm cooking the deals for the next 3 years, and I'm looking at where are we going to be financially 3, 5, 10 years out. I'm not really concerned with what's happening in the next quarter. That's not my job. And that's what it also points out to, is what's the investment horizon of your CEO. And so when the CEO is acting opportunistically in the M&A realm, they're really also telling you that they're an operator, that they're generally operating tactically, and they're looking at a 6 to 12 month horizon in terms of what their goals and their vision, their strategy, everything is working off of. You really should be working on 5 and 10 year projections, as a CEO. So that's exactly what I would feel, that there was no reason for them to lose that position. Sorry, that's a long.
That's great. No, that's it. I think it's a nice insight. Thank you.
I'll just give you another way of how this works in a very simple way. So here's the CEO or a guy who's running a sports team. He says, hey, bring me Olympic quality athletes. But in reality, I have no interest in competing in the Olympics. And at the end of the day, you're not going to be able to acquire Olympic athlete talent if you're not going to the Olympics. And so it's a very simple analogy, but I'll show how this works in the corporate realm, where the CEO says to us, hey, bring me globally competitive talent. Well, by the way, I don't have a big vision. I don't have big ambitions. I don't want to compete globally. Well, guess what? You're not going to get the best talent. And it becomes a downward cycle. There's upward cycles and downward cycles. So all of a sudden, your board and your CEO don't have a big vision. You're not going to be able to attract big talent. You can't get good talent. You're not going to have a competitive offering. You don't have a competitive offering, you start losing money. And very quickly, you become a blockbuster. Very quickly you become, you lose it. And we're in a world where it's grow or die. And unfortunately, I know it sounds a bit rough, but this is how the business works. And so there becomes some very big oxymorons in the existence of the leadership in what they're doing. And so we want to assess this. So what really quickly becomes like a very small discussion about M&A, and I say small because it's really, not seen as the core skill of a CEO. It's a sliver of a skill set, but all of a sudden it opens up a can of worms by the way they're answering it, the way they're talking about it, starts to tell us other things. So what are the capabilities that we really want to test for, or where should your CEO be adding value? Because the other critique that I get is, people are like, Shane, that's not the CEO's job. That's your CFO's job, and they don't need to have these financial skill sets, et cetera, et cetera. So let's just look at what, we really feel is within the realm of the CEO's remit. So origination and the target strategy. I think I just flogged this to death, because your job as a CEO is setting that vision, setting that strategy. You can't do that, you're disqualified. You shouldn't pass the assessment. You shouldn't pass the interview. Unfortunately, they are, because they're being, for whatever reason, we don't need to go into why they're not. The financing plan. So, have you changed your capital structure? What's your philosophy around what your debt to equity mix should be? Do you really understand how to create credit enhancers? Do you understand how to get, access to that kind of liquidity that you need? People will argue that's part of your CFO's job. The CEO definitely will play a hand in it. Evaluation and due diligence, to me, 100%. I want a CEO that is going to challenge the assumptions of the acquisition in place and get me a better acquisition price. A big part of my money that's going to be made is going to be made on my acquisition price. So I really want a CEO who's able to really start to question and really be effective on the negotiation table. And then post-acquisition value creation. This is 100% the CEO's job. And, unlocking value, creating synergies, and making sure it works. And then really being committed to, either we're going to grow this business, where, some companies, they grow for next 100 years, or, we're going to exit at a multiple. And if you're exiting, you really need to weigh, if they're not able to exit on a multiple, don't let them off the hook on that. You are responsible. Obviously we need to look into exactly what happened, but you really want to look at what that, what the multiple is that they were able to exit the asset at.
Chen, what do you mean by exit or growth?
So if I'm going to acquire a business, generally, if I'm a private equity person, I will hold the asset from anywhere from 5 to 8 years, and then I'll exit and sell it. So as a CEO, if we're buying that business, there's only two options. We're either going to keep the business and continue to grow it. So if you acquired something, I want to see the results in the asset. I want to see the revenue growth. I want to see the net profit growth. And we talked about that before. Don't let the CEO off by claiming that he has a good EBITDA and that the EBITDA growth is, we're positive because we have EBITDA growth. He's claiming EBITDA because you're over leveraged, you have expensive assets, and when you put it all together, you're actually losing money and the business is in trouble. So I want to see that life cycle. A CEO who can do all 6 of these is like, super, I guess you can't say Superman anymore. That's a very sexist term. There's a Superman or Superwoman or anything in between. But it's a really tough gamut of skills to be successful across all these buckets.
Absolutely.
But at least, if you really know your business, and that's where the example where I said T. Pickens, as a business owner, really knows all parts of their business. So they really understand which targets to go after. They really understand how much leverage the business can hold without taking on too much risk. They really understand where the gaps are in the assumptions to hit the evaluation and get the evaluation price down. They're very effective in negotiating. Of course, because you're an operator, you grew up as an operator, you know your business, you know where the value creation levers are, and then when to right size, when do you get out of a particular business line. So these are some more questions. So for me, once I'm getting into it, I'm first going to ask them, what's your discount rate? How did you calculate your WACC? If you have multiple locations, how do you use your WACC across all of them? If you have multiple assets within your group now, have you created an internal capital market? So for example, if I'm a pan-regional business and I have offices in Abu Dhabi, Dubai, Jeddah, Riyadh, Muscat, giving $5 million to Muscat is not the same as giving $5 million to my Riyadh office, and they shouldn't have the same weighted average cost of capital. So looking at the WACC, looking at the discount rate, and then I would ask questions like this. This is a great question. For somebody who's really involved, how do you deal with patents? How do you deal with goodwill? These are very intangible pieces. How do you calculate the value? And give me an example where you have. Now, the CEO who is surrounded, because remember, you're being surrounded, you could be surrounded by, likes of, JP Morgan, Goldman Sachs, the big 4 accounting firms. These are competent people. So you may not be that involved in the acquisition. So again, what is this? This is what we call in the world of assessment, separator questions. What is a separator question? Is we want to separate a good from a great CEO. How do we cut that hair? Because somebody who's very good and has a great use of language, they're going to fool you into thinking that they're great, and they're not actually great. And if you want to beat the market, you need to be hiring great. You can't hire good, because good means that you're with the market. You're beta to the market. If we want an alpha, you need to make sure you're getting that great. So how do we tell the guy who really rolled up the sleeves and got into the engine? So these are the questions. So where did you challenge the finance team or challenge the consultants that, hey, this evaluation is not right? Where did you do that? And how did you do that? And that's where you're going to start to get. So for example, here in this third question, a guy was acquiring an aluminum smelter. The aluminum smelter had 7 locations. They had a particular price for the business that the client wanted. my client assessed that business and he said, no, you're using one whack across all these locations. It's not true. We have to go in and give a different risk profile to every single one of the locations, each one of the subsidiaries, because some have aging equipment, some have modern equipment. And he was able to reduce the acquisition price by 20 to 30%, going in and challenging how the evaluation was done. So I don't know if the audience has any questions. I haven't been able to check the chat box. I don't know what that means. M&A. So the other thing is, this last question is also like a very easy one to get a grip of how involved the CEO is in evaluation. And this is where, when I go back to my first slide by T. Boone Pickens, where it said a lot of the managers, the CEOs, don't really understand who their shareholders are. That's really disconnect between an owner and a manager. And the owner is going to really want to know, because you own it, you want to know how much it's worth. So you're going to go and you're going to ask, hey, evaluate my business. And guess what? The guy at PwC or E&Y or whatever, he's going to say, oh, here's your evaluation. You say, what are you talking about? It's 30% less than what my discounted cash flow says it should be. And he's like, oh, no. You're a private company. You're not publicly listed. So we're going to take 30% off right away because it's not that liquid. We can't really sell it. So the owner is going to say, well, why are you taking 30% off for no reason at all? And of course, you're going to immediately start to get into these conflicts. And then you're going to start to say, well, what approach are you using? And what are the different, if you do a comparable analysis versus a precedent versus the net asset value versus discounted cash flow, and you're going to start naturally having these dialogues because you want to make sure you're getting the right value. And you want to then see, so here's just a quick overview of a couple of the different ways that you can look at it. These are like very common ways. So you're a public company comparable with, say, me, Nasser, and Pete all own strategy consulting firms. They're publicly listed, and Nasser and Pete sold their business. Pete got 12 times EBITDA, and Nasser got 15 times EBITDA. So then I'm going to go back and I'll say, why are you offering me only 8? Here's these other companies that got 12 and 15. You should give me 18 because mine's amazing. Or the guy will say, yeah, but you're not as good as Pete. You can only get 8. So what is that comparable? Precedent transactions obviously is fairly easy. It's very similar transactions that took place. And then your discounted cash flow, which is it's always an interesting one because you're basically saying, okay, over the next 5 years or 10 years, this is how much cash flow the business is going to generate. And then I'm going to discount that to get the net present value of the business. And so that's fine. It doesn't actually matter. You, as the assessor, do not need to necessarily understand the intricacies and the complexities of doing the evaluation. What you want to see is that the CEO has been able to understand the evaluation process and has been able to attack that process on the assumptions that were being made and not accepting reality. Because number one, what we want to believe, I don't know if you guys believe this, is reality doesn't really exist. A Rolls Royce takes you from A to B. So from a technical intrinsic value, that vehicle, you can't say it's not necessarily better than a Honda, because a Honda is definitely going to take you from A to B, and it's very reliable business. So where is that premium? A big premium in the Rolls Royce is imagined. It's in the brand. And so this brand is totally made up. And so all of these evaluation techniques, and I know I'm going to upset a lot of finance people on this call, are totally irrelevant, because no matter what, you can say this is what your enterprise value is, or this is what our intrinsic value is. Well, if you go back to the example of a bottle of water, And I tell you, and you're sitting there, Nasser's sitting in his office, he's well hydrated, you know, he probably had a good healthy breakfast, he's all good. He's not going to pay a premium for a bottle of water. But if Nasser was in the empty quarter and he hadn't drunk for 2 days and he was about to die, he'd offer me $1 million for that bottle of water. So what really comes down to evaluation is the motivation and the psychology of the buyer will trump all the technicalities that any CPA, CMA, ICAW, ACCA, ICAF, CFA, or whatever qualification you want to throw at it, will always be trumped by the psychology of the buyer. And so we really want a CEO who understands that the evaluation is up for grabs and we're going to go after it. We're going to give it a gut punch. And we're going to hit it. Where are you going to hit it? Where is it vulnerable? Where are the assumptions being made? That's what you want. That's what you want out of your CEO who's running it. And CEOs who are involved in this, they're going to love talking about it. They're going to really, you know, start opening up. And the other thing you want to watch for is when they get defensive. So they're like, listen, Shane, let me explain. As soon as you see that behavior, it's basically their ego is protecting their imagined sense of self that says, hey, I'm this amazing CEO who has this amazing skill set, and you start poking holes in it, they're going to start to get defensive. They might start to get angry. These are really like red flag behaviors that you see in an interview. A person who really has a great skill set, you know, if you start asking, you know, the late Albert Einstein about physics, he's going to love talking. If you start asking Neil deGrasse about, you know, how the universe works, he's going to enjoy talking to you about it. He's going to start, you know, explaining this to you. It's the guy who doesn't really know the answer that's going to start getting all riled up. So, Pete, I don't know if we have any questions from the audience, because I can't really see, but those are, just to recap here, some of the quick questions that we would go after is, again, going into the nitty gritty detail. You know, if I tell you, guys, I'm a barbecue master. Now, how do you tell the difference between a guy who likes to cook on the barbecue once in a while and who's a master? Well, you know, how long should the chicken be on the grill for? How long do you flip it? What temperature do you get your grill at? What's the internal temperature of the meat if it's going to be well done versus medium rare? You know, you get them on the details, and that's where.
Yeah, I think this is actually really the key. Shane's point is totally correct here. It's this, and my good colleague of mine talks about the theory of the case. You know, and his description in senior level interviews is, I don't really mind what the answer is, but I want to know that the person I'm interviewing has a well thought out hypothesis, that they've done the research, and that they can articulate their theory of the case. And I think that's when it comes to M&A and elements like this, someone who is if you need an expert, you want someone who's been through it and led it before, means they're going to come out of that process with some battle scars that has helped them identify their theory of the case or their point of view in relation to M&As. And I think once you get them talking, it'll be tough to stop them talking. So you will really know the difference between someone like that versus someone who might have just read a few textbooks and the odd LinkedIn article and can come with some nice buzzwords. You know, if M&A is so critical in the selection process, you've got to dig into it in significant specificity during the assessment, and that will allow you to pick a person who meets the needs of the role that you're pitching for.
Right, and if you want more information on this, we're actually having the first ever to my knowledge, certified CEO assessor course, which will be backed by SP Jain School of Global Management, and we'll have a professor, the dean and CEO of the Dubai campus, Professor Christopher Abraham, will be talking on behavioral science. We also have a professor of finance as we go into kind of these topics, the M&A a bit more, and we will have potentially some celebrity CEO or some very well-known CEOs from the region as guest speakers. And you can watch if you want. If you don't want to wait for the course, you can get the book, and you can see an overview of the book online, which walks through all of this. And if you want a free sample of the book, you can get it from our website, which you can just download from the book page. And there's a second sample. So the first one is testing generic finance skills. And then the second sample is how do you tell if your CEO is a rainmaker? Can your CEO make money? If you want that one, just send me an email and I'll send you the password to get that. But that's all we got there. Do we have any questions from the audience? Maybe I can stop sharing my screen and see our lovely audience here. And I don't know if anyone has any. So yes, Deb Narayanan has a comment. I'm not sure if I totally get what Deb is trying to say here. If you want to explain yourself. Yeah. No, you can just unmute yourself and join in if you want to. If you have a question, you know, you can just ask it if you want. I don't know if
I think what he was trying to get to, you know, when you talked about the evaluation of the CEO, and he said, okay, you might add to it the flavor of the due diligence where you can check his finance capabilities and basically the legal, you know, capabilities as well, you know, reading, you know, legal documents, make sure the legality of the M&A itself, is it legal or not to be done, especially when you look into large mergers, you know, where basically you need to have some sort of authority approval. Probably that's what he was luring towards. Technical and complete is required. So I don't know. I mean, basically from technicality aspects as well. I'm not sure. You know, probably that's what he was trying to get to.
Sure. Fatal's sorry. Mr. Hubert is asking me if I'm the CEO of my company. I guess I would be. I mean,
you are, Shane. Absolutely. I think it's on your business card. Look at you.
It is, but you know, my company's infinitely smaller than Mr. Hubert, so I don't know if it can be considered a real CEO in that sense. But you know, we're just a small, we're a smaller business. But you know, I think you know, for example, I'm a sole owner, so I don't have a board to answer to, which may not qualify me as a real CEO, if you will. Hubert, I don't know, you're muted. I don't know if you want to. It looks like you're trying to talk, but you're.
No.
I don't know if you're trying.
Oh,
there we go.
to your answer.
Anyway. Hi. Yeah, we can hear you now. Sorry, what was that?
Just listening to your answer. Yes.
Oh no, thank you so much for joining. It's good to see you. So great, and there's Mr. Ibrahim there as well. Nice to see you. So great. So I guess Deb is saying how much liquidity share or debentures. Yeah, I think you need to, you know, once you get into the individual transaction, the more detail that the CEO is able to speak with, the more likely you have someone who's really who can really lead this strategy. Of course, you know, for the CEO, for you really to have an inorganic growth strategy at play, you know, you're really going to have a board that has a higher risk profile. And a lot of these acquisitions, it doesn't necessarily, they don't all end like Simmer and Sorrel and WPP. There's a lot of things that can go wrong. So again, it's not necessarily the core element of what we want to do. So there's any other questions at all that we have? For this? No? Pete, you have anything else that you wanted to add?
No, I really wanted to end by, you know, it's such a fascinating topic. It's one of the most critical decisions that that boards make, and the science is still unclear. And that's why I think where people like Shane trying to push this more towards evidence-based decision making will really help. I think particularly in this region, there still is a temptation to make kind of very subjective decisions on some of these decisions, and the opportunity to be more evidence-based means we'll be more likely to be able to make the right decision. So, fascinating topic. Thank you very much, Shane, for guiding us through this. This expertise is super interesting. I do have to log off now, so I have to say goodbye to everybody. But thank you, Shane, and thank you, Nasser, and I look forward to joining at you very soon. Okay.
Thanks, Pete. Thanks so much. So just so you guys know, what's coming up next week is we just finished the finance section. So what we covered was basically, can your CEO manage a P&L? Can your CEO lead an M&A? And then we're going to look at next week is, can your CEO use financial metrics to drive peak performance in your business? And then we're basically that will be kind of the end of the finance section of our assessment topics. And then we'll be looking at, can your CEO make money? Are they a revenue generator? And for some reason, this is often skipped in the assessment. What are the core skills that you really want in someone who is a bona fide rainmaker? And then we're going to get into the leadership. What's the difference between a leader and a manager? And what should a leader be doing? If they are a leader, what are the core things that you should be doing to manage your team? A lot of times you meet a CEO and you can tell that the way they're running the management structure that they're using is not efficient, and there's going to be issues. And then how the CEO can set a goal, because at the end of when you're looking at leadership and management, it's your ability to set long-term goals and achieve the long-term goals in a group environment. And then Pete's going to be doing a presentation on high support, high challenge. So how do you, as a leader, really give someone a hard time? Give them a good challenge, but at the same time, you're warm and you're there for them. And then we go into strategy and power, authority, and succession planning, which is the last of the skills. So that's the series. So if I can stop sharing there. So that's what will be coming up. So thanks again, everybody.
That was great, Shane. That was really great. One more thing that I was going to say, if the CEO has a track record in M&A, that will add a lot of substantial value right from the beginning of the interview.
It can be, but it can also be maybe the board doesn't have the risk appetite. So I mean, it's horses for courses. So if you're going to bring in a heavyweight CEO who does the M&A, but you're not really going to support them at the same time, the guy, he will resign, he will quit, or she will quit. But yeah, it's a double-edged sword, but you have to be clear on what you want to do. So I just want to thank everyone. Thanks again, Nasser, for co-hosting with me and joining. It's nice to see you. And again, that's Nasser Zega from Digital Analytica. If you're doing any digital transformations, he's really the guy to talk to. And thanks again for all the amazing guests that we have here, and guys like Deb who are sending the comments and the questions. Please keep them coming. We really appreciate it. And thanks for everyone. It's really a pleasure to share my passion for this topic with you guys. And thanks again.
Thanks, Shane. Thanks, everyone. Hope to see you next time. Have a good one, everyone. Bye-bye.
Okay. See you later.